Financial fraud leaves a highly specific type of wreckage. It strips away homes, eviscerates retirement funds, and upends working-class lives, usually while the architects of the disaster avoid the worst of the fallout. When the system does manage to catch a high-profile thief, the public demands a spectacle of punishment. We expect to see them stripped of their wealth, locked away in federal prison, and paraded before the cameras to prove that the rules apply to everyone. Yet one man engineered a massive Wall Street scam and received a radically different treatment. Instead of dying in a cell, his crimes were packaged into a Hollywood blockbuster, and audiences paid millions to watch an A-list actor play him on the big screen. Behind the cinematic partying is a stark reality. Jordan Belfort stole hundreds of millions of dollars from thousands of ordinary people. He served fewer than 2 years in a minimum security camp, and today he still owes his victims $110 million in court-ordered restitution. Those victims are still waiting for their money to be returned. Belfort, meanwhile, tours the world as a highly paid motivational speaker, charging massive fees to teach the exact sales tactics he used to defraud desperate families. The stock market manipulation was highly effective, but his true masterpiece occurred long after the FBI raided his office. He managed to convince society to applaud the thief. The blueprint for that grift began in Queens in the 1980s. Before he touched a stock, Belfort ran a door-to-door meat and seafood business. He had no trucks, no storage, and constantly dealt with spoiled product, but he still drove $100,000 a month in sales. When the business went bankrupt, he walked away with a crucial insight. If the pitch is aggressive enough, the actual product is irrelevant. He brought that aggressive pitch to Wall Street just in time for the 1987 Black Monday crash. Fired from a legitimate brokerage, he pivoted to the dark corners of the market, pink sheet penny stocks. These were unregulated, illiquid companies that serious brokers ignored, but they offered 50% commissions. He needed a vehicle to push these stocks, so he created Stratton Oakmont. The name sounded like a century-old institution with leather-bound books. In reality, it was a boiler room stuffed into a Long Island strip mall, staffed by bartenders, college dropouts, and local hustlers who possessed zero financial credentials. To turn these amateurs into closing machines, Belfort developed a framework called straight-line persuasion. He taught his recruits to aggressively bulldoze hesitation, drown out a client's doubts, and push the target toward writing a check in a single, unbroken line of psychological pressure. The target demographic for this pressure cooker was highly specific. They rarely cold-called Wall Street insiders. They dialed working-class retirees and anxious parents, people seeking a financial lifeline who lacked the expertise to spot a worthless company wrapped in false certainty. The firm bought massive blocks of cheap stock, then flooded phone lines pitching shares. Artificial demand forced the price to spike vertically. At the peak, Belfort's inner circle sold their shares. The stock instantly collapsed, leaving retail investors holding worthless paper. The resulting influx of stolen cash fueled a toxic, adrenaline-soaked office environment. Brokers wore $2,000 suits and consumed heavy narcotics to survive the punishing sales quotas. Fights broke out over commissions, and lines of cocaine were regularly snorted right off the firm's compliance manuals. As the firm brought in hundreds of millions, hiding the illicit gains required complex financial maneuvers. Belfort parked accounts in Geneva under fake corporate names, routed money through the UK using his aunt's identity, and even used couriers to smuggle cash stuffed in envelopes across international borders. The paranoia of the investigation and excessive drug use eroded his judgment. While high on Quaaludes, he insisted his yacht captain sail from Italy into a severe Mediterranean storm against all warnings. The vessel took on water and sank, destroying millions of dollars in jewelry and narcotics as the Italian Navy rescued his family. By early 1997, the FBI was already piecing together wire records. Belfort was explicitly warned not to move his money, but he ignored the directive and wired $2 million to Switzerland. Federal agents traced the transaction, recorded the conversations, and raided the Stratton Oakmont offices. The complex web of offshore accounts and cold call scraps held up remarkably well. What ultimately destroyed the firm was the very trait that built it, a profound arrogance that convinced its founders they were immune to the law. Facing 30 years in federal prison for securities fraud and money laundering, Belfort utilized his primary survival skill, He sold. He flipped on his own firm, wore a wire, and provided evidence against the employees who had learned to sell from his playbook. Over 30 of his friends and partners were indicted. Because of his cooperation, he avoided the 30-year sentence entirely. He was sent to a minimum security facility with no cells and unarmed guards. He spent exactly 22 months playing morning tennis and lifting weights, while several of his subordinates served longer time than he did. While serving his time, he met comedian Tommy Chong, who was incarcerated for selling bongs online. Listening to the endless stories of sunken yachts, smuggled cash, and rampant fraud, Chong recognized the commercial value of the narrative and encouraged him to write it all down. Those writings became a best-selling memoir, devoid of any apologies. By 2013, the story had been purchased by major studios and directed by Martin Scorsese. The cinematic adaptation focused entirely on the intoxicating thrill of the excess, effectively erasing the perspective of the people whose lives were ruined to fund it. Today, the man who drained the life savings of teachers and war veterans stands on brightly lit stages, selling seminars on corporate ethics and success. He continues to amass personal wealth, while the $110 million he owes his victims remains largely unpaid, vanishing into legal loopholes. A fraudster and scale rarely escapes both prison and public disgrace. The uncomfortable truth is that he got away with it because a large segment of society ultimately respects the accumulation of money more than they care about how it was acquired. We forgave the wolf because deep down, we wanted to be him.